Hey everybody, I'm Stacy with Pitch Deck Fire, and I'm so glad you guys have joined us for another one of our pitch hacks of the week this week. If you haven't been with us before, we cover tips and tricks on pitching, pitch decks, sales decks, investor decks, and live presentations. So if you're a startup looking for funding or an established company looking for new customers, maybe you're an accelerator or an incubator program at your own corporation, all of you guys can find value in what we talk about here on Pitch Hacks. So let's hop right into it. What's this week's pitch hack of the week? All right, this week we have, is my business a fit for funding? Before we launch into that, let's ask one question first. What kind of funding are you looking for? Because different kinds of funding are better or worse for different kinds of companies, or even available to different kinds of companies. So first, let's look at equity versus debt funding. Those are the two kind of main fundings for companies like yours, debt and equity funding. So what is debt funding? Debt funding is when you get investment or funding for a debt. You actually owe that money back over time with interest. Maybe there's a horizon on when you need to pay it back by. You might have opportunities to refinance, things like that, but it's something you're gonna have to pay back. You owe that money regardless whether or not the business succeeds or fails, depending on how the contract is set up. And you might have collateral as well, like a building or a piece of equipment, something like that, that you have on, as collateral for that debt. So if you fail to pay the debt back, the bank or the person who owns this debt financing then owns the piece of collateral itself, or can sell it off to make some of their money back from the investment that they gave you. So that's debt financing. And then we also have equity financing or equity funding, which is a more commonly talked about kind of funding in the startup space, primarily because you don't tend to have a lot of physical equipment or big things you can use as collateral. If you don't have those things, it's very hard to get debt funding, and many people talk about, there's a lot of buzz in the industry about equity funding. And so equity funding is when you get funding for a piece of your company. So you're giving away a chunk of your company or your future earnings, your future valuation of your company to someone else for their money. So you're going to take $100,000 now, and maybe if you guys value your company at $1 million business, then they get 10% of your business. So you're giving away a chunk of your business, you're valuing your business right then, you're giving an evaluation, and you're getting a chunk of money. Now the goal with equity financing is that you're going to make enough money that the person who's invested in your company, who now has a piece of your company, they own a percentage of it, that they make more in the long run, that they could sell their share later and make more money, because they're hoping that with the money they give you, you turn it into a bigger company with a bigger valuation. Your $1 million company today is a $1 billion company tomorrow, and they get 10x on their return. They get more money back in the future for the money they put in today. So when we're asking the question of, is my business a fit for funding, we want to make sure we're asking which type of funding we're talking about. If you're a business that has physical collateral, like a restaurant or something like that, maybe you have big equipment or something that you can put up for collateral, equity might be a good fit. You don't give away any percentage of your business, and you get money, and then you just owe it back. Another option is the equity funding. That might be a fit if you don't have collateral, if you want to have the advice and support of an investor who can support you in your growth beyond just giving you funding. And it's a little bit less risky feeling to people because you're giving away a portion of your equity rather than actually owing the money. So if the business fails, you don't technically owe it back. Now you are going to piss off your investors and probably not be a very positive, positively viewed investment in the future. So you should really only start businesses that you think you're going to be successful at. But giving away equity for money can sometimes be a better option or the only option, depending on how your company is, where your company is in its life cycle. So when we're thinking about whether or not funding is right for us or whether we're a fit for funding, we want to think about a couple things. I'm going to mainly talk about the equity side of it. So when we're thinking about how or if we're a good fit for funding, when it's equity funding, what we want to look at is whether or not we are early or late stage in our company. So if we have already gotten some traction, some customers, some proof, that can be very valuable to getting funding, and it can give us a higher valuation, and then therefore people take less percent of our company for the same amount of money invested. If I need $300,000, then if we're valuing my company at $1 million company, that's 30% of my company. If we're valuing my company at a $20 million company, it's a much lower percentage of my company for the same amount of money. And so if you have traction, we can sometimes get a higher valuation. And so if you're looking for funding, especially from venture capital firms, you're going to want to have more traction or more success with your company so far. Also, if you're looking for funding, another thing to keep in mind is the actual size of the market itself. So what opportunity do you actually have? Is your company something that can attack a very large market and take a very large market share? If so, then you have this opportunity for really rapid growth and for really big growth from where you are today, which makes you a more attractive investment for venture capital angel investors or other kinds of investors. They're looking for that return on their investment. They want to see that the money they put in is going to turn into a lot of money later. So if you have a very tiny market size, the likelihood of that is smaller. So we're looking for big markets and big opportunities to attack a market. Maybe it's a market that doesn't have a clear winner right now, or it's very easy to take the number one spot. So keep in mind what that means for you. Also, we want to think about scalability. Most investors are investing in companies that are highly scalable, meaning that money that goes in can be 10x. It's possible. If you are producing a physical good, or you are a service-based company, there's always some component of effort and cost of goods sold that goes into every product that cannot be taken out. If we're a physical product company, if we make a product, all the money and effort that we use to make that product, all of the costs of that goods, we're never going to be able to get rid of that. It can be lower over time or with economies of scale, but it's never going to be gone. We're going to have this cost no matter what every single time we sell the product. With a tech company, which is why a lot of investment is happening in the tech space or software as a service space, you build something, you have some upkeep and things like that happen over the years, but you build something and it is used and paid for month over month over month, and many people use it. Maybe many transactions happen on this thing that you built once. So the main bulk of the cost of goods sold went into it once, and then it's very scalable in terms of how much we can make over time. It's very scalable. We can sell it over and over and over again without having that cost have to occur every single time. So a business that has a more scalable solution is often one that can get better opportunities for investment and is a better fit for investment. So I would look at how much traction you have, whether you're a better fit for debt or equity financing. I would look at your type of business and whether you're a very scalable business, and the type of market that you're attacking and how big the market size is. Those are the kinds of things I want you to think about when you're thinking about whether or not you're a good fit for funding. Keep in mind that any kind of funding is in some ways dangerous. Organic growth is best. It's often not possible because you just have to grow fast enough to take over a market, or you just have to make it to a point that you can be successful at, and it takes some money to get there, right? Maybe building the MVP takes a certain amount of money. It's definitely the case where you may not be able to do it organically, but it would be probably best if you could do it organically. If you could pitch to potential customers, if you could get customers on, if you get your marketing right, if you get things lined up in such a way that you could organically grow your company, it would be the optimal solution. It's not often the case, it's not often possible, but that would usually be the optimal solution for most types of companies. So hopefully that answers your question on, is my business a fit for funding, or at least gives you some things to think about when you're considering whether or not funding is right for you. Thanks so much for joining us this week. Again, I'm Stacy with Pitch Deck Buyer. We put together new pitch hacks every single week. So give us a little thumbs up or subscribe, and you should find out about our next pitch hack video coming up next week. If you have any thoughts on funding or how to decide whether funding is a good fit, I'd love to hear about it in the comments below. There's a lot of different ways to think about this, and everybody who's thinking about getting funding could really benefit from your thoughts and experience if you've gone through this before. So please comments below. Also, if you have any ideas for upcoming pitch hacks, there's a link down below as well. I would love to do a pitch hack for your pitch hack question or idea next week. Thanks for joining us. I hope to see you guys here again soon. Happy pitching!